bring in Liz Young-Thomas of SoFi and a CNBC contributor, Jason Snipe of Odyssey Capital Advisors as well. It's good to see you. Welcome here. Tony sounds pretty positive to me. You sound like you don't match that. I know that laugh.
The data right now suggests that positivity is warranted.
Yeah.
I think what we learned a couple weeks ago is that the market is not bulletproof, and it makes sense to broaden out your portfolio if it's not broad enough. And I say that for a couple reasons. Number one, the tech trade has lost a little bit of momentum. I mean, it's bounced back quite a bit. We're almost back at the highs on the S&P, obviously driven by a lot of that mega cap group. So it's bounced back a decent amount, but we do still know that those are the easiest names to sell when people get scared. So you want to make sure that you're still exposed to other things in risk assets and some of the sectors that typically do well when the environment shifts. And we know that the environment is likely to shift come September and November with the Fed.
I'll play your analogy. Yes, it maybe proved that it wasn't bulletproof, but what if it has a bulletproof vest? And what if that is this still good economy, still good earnings, still hanging in consumer, and rate cuts that we haven't even had yet?
So rate cuts are not typically something that the market celebrates throughout the cutting cycle. We might celebrate it as they're approaching and then in the beginning of it, but then as they continue, if the data slows down to a point that people start to get nervous, and I think we've seen that markets have gotten nervous when data comes in cooler than we expect now, which is a tone shift. If the data slows down more than markets expect during a cutting cycle, the cuts start to get interpreted as reactionary rather than proactive.
Unless they're just normalizing, right?
Absolutely.
You're making the point that, you know, if they've cut prior, you know, throughout history, they've done it because the economy has needed that level of cuts. And the more they've cut is because the economy's been weaker and weaker and weaker.
Right.
It might be different this time, dare I say.
It very well may be. And a lot about this cycle has surprised me, and I've gotten a decent amount of it wrong. So I am open to being wrong again. But what we have to remember is that as the Fed is cutting into a weakening economy, it can get dicey. And it is tough for the market to digest that and interpret why the cuts are coming. And right now, we're so sensitive, not just to when they might start cutting. I think we've gotten comfortable with it begins in September, but the size of the cuts. I'm on the side that I don't think 50 basis points is that big of a deal, because they raised on the other side when we were coming into this, they raised by 75 basis points 3 times in a row. So I don't think 50 basis points would be an alarm, but I think the market would be a bit alarmed by that. So I think really more so we're going to have a digestion issue as we work through this. And even if we do secure a soft landing, the data is going to contradict at different levels. Some of it's going to be slow, some of it's going to be hot, and the market's going to have to react to that. And we're very reactive right now to every little piece that comes in.
Okay. Jason Snipe, what do you think about what both Liz and Tony Pasquarello had to say about their market views?
Yeah, no, I agree with a lot what was already been said. I think the disinflationary narrative is very much intact. We got a retail sales number that was solid, and labor is softening. So to Liz's point, I think the soft landing story is very much intact. I think as it relates to Friday and what we'll hear from Powell, I think he'll tote the line. He'll be right center stage. You know, as far as his commentary, I don't think he'll be overly dovish. I definitely don't think he'll be hawkish. I mean, this has been the ultimate telegraph. Why would he doesn't need to double down on being overly dovish. I think he'll acknowledge the disinflationary narrative that we've all seen. I think there will be a moderate pace of cuts. I don't think there needs to be a 50 basis points cut whatsoever, because I think the data is supporting that. And then obviously I'm following the bond market, what the bond market is telling us. So that is obviously looking for cuts. And I think if we do it at a moderate pace, 25 basis points, you know, over the last 3 meetings of the year, and then go into 2025, I think that will be effective. I think that's what the market is looking for.
But, Jason, I mean, if we're at 5,600 now on the S&P, what seems reasonable to you between now and the end of the year? With the election looming, we've got to get through more earnings between now and then. We have to figure out this cutting cycle. And we're going to obviously watch the trajectory of both the economy and the consumer.
Well, I think, honestly, I think we could see another 5%. You know, if I turn to earnings, what we've seen already this this quarter. 95% of the S&P is already reported. We're at 10.8% earnings growth, which is very solid, and I think it continues to get revised, higher going forward. So I think we could easily see, 4 to 5%. Growth from here, which I think would be a solid return for the year. Again, it's been a great year thus far. A lot of, to your point earlier, Scott, a lot of it's been priced in terms of monetary policy. But I do think we end higher, as it relates to the price action for this year.
How do you answer that question? 5,600 now. What's then?
So I think the other thing that we learned in the correction that we had a couple weeks ago is that afterwards, the market needed good news in order to bounce back. So I think now, in order to get back to those highs and surpass those highs, I think it's absolutely possible, if not probable, because we're pretty close and the momentum is here. Mm-hmm. In order to surpass them, we need that good news. And I think that good news can come in the form of what Jason just said, which is retail earnings. We had a good start with Walmart on a big lens into the consumer, which was strong. What I think we need to hear from other retailers, particularly those this week, is the same theme, that they're not worried about a huge slowdown in consumer spending for the remainder of the year. We need to hear that guidance is at least solid, if not improving, and that we're not supposed to be worried about the consumer, because that was the thing that was going to break the whole thesis.
This is good, though, right? That good news is good news again, and bad news is bad news.
Absolutely, because
before
it was very
we had this
confusing.
warped